July 11, 2008, Pasadena, California. By mid-morning, depositors were lining up outside branches of IndyMac Bank. News had spread that federal regulators were about to seize the institution. Inside accounts were more than $30 billion in deposits for some customers. Balances exceeded federal insurance limits. By the end of the day, the Office of Thrift Supervision had closed the bank and appointed the Federal Deposit Insurance Corporation as receiver. It was one of the largest bank failures in U.S. history at the time. For uninsured depositors, it meant potential losses. To understand how that moment unfolded, you have to step back to the housing boom of the early 2000s. IndyMac began as a mortgage lender and later converted into a federally regulated savings bank. Its business model centered on originating and securitizing residential mortgages. According to regulatory filings and public disclosures from the mid-2000s, the bank expanded aggressively into Alt-A and non-traditional mortgage products. Alt-A loans typically fell between prime and subprime categories. Borrowers often had higher credit scores than subprime applicants, but provided limited documentation of income or assets. So-called low-doc and no-doc loans became common across parts of the industry. During the housing expansion, this model generated rapid growth. Between 2003 and 2007, home prices rose significantly in many U.S. markets. Mortgage origination surged nationwide. According to SEC filings from that period, IndyMac's assets grew rapidly, surpassing $30 billion by 2007. The incentives were clear. Mortgage origination produced fee income. Selling loans into securitization markets transferred credit exposure to investors. Rising housing prices reduced apparent risk. As long as property values increased, refinancing remained an exit option for borrowers. But structural vulnerabilities accumulated. IndyMac relied heavily on brokered deposits and wholesale funding sources, rather than a broad base of stable retail deposits. Brokered deposits are funds gathered through intermediaries, often attracted by higher interest rates. They can be more sensitive to market perception. According to regulatory reports issued after the failure, this funding mix increased liquidity risk. If confidence weakened, brokered deposits could leave quickly. At the same time, underwriting standards across parts of the mortgage market deteriorated. Option-adjustable rate mortgages, interest-only structures, and reduced documentation loans became widespread. Rising home prices masked repayment stress. In 2006, housing prices began to slow. By 2007, many markets experienced declines. As property values fell, refinancing options narrowed. Borrowers with limited equity faced payment resets. According to publicly reported data and later investigative findings, delinquency rates in Alt-A and subprime categories increased significantly during 2007. IndyMac's loan portfolio was heavily exposed to these segments. Losses mounted. In 2007 and early 2008, the bank reported increasing provisions for loan losses. According to SEC filings, credit quality deteriorated as defaults rose, earnings declined, capital ratios tightened. The broader financial environment was also weakening. Secondary markets for mortgage-backed securities became illiquid. Investors demanded higher yields. Access to capital markets narrowed. In June 2008, additional pressure emerged. Public reporting and regulatory correspondence became part of the narrative. A letter from a U.S. senator to regulators expressing concerns about IndyMac's financial condition was widely circulated. According to later regulatory assessments, the publicity contributed to depositor anxiety. Within days, deposit withdrawals accelerated. According to FDIC documentation, IndyMac experienced approximately $1.3 billion in deposit outflows in the days preceding the seizure. For a bank dependent on less stable funding sources, that scale of withdrawal intensified liquidity strain. Regulators faced a choice. On July 11, 2008, the Office of Thrift Supervision determined that IndyMac was no longer viable. The FDIC was appointed receiver. It was one of the first major bank failures of the 2008 crisis. Unlike larger institutions resolved later that year, IndyMac's collapse directly affected uninsured depositors. According to FDIC statements at the time, accounts exceeding the insured limit were not fully protected. Some customers faced losses above $100,000, which was the FDIC insurance cap before it was temporarily increased later in 2008. For those depositors, the day regulators closed the bank was the day they realized federal insurance had limits. The rise of IndyMac reflected a broader industry dynamic. Growth in higher-yield mortgage products generated short-term revenue. Securitization markets enabled rapid expansion. Housing appreciation created an illusion of stability. Funding models relying on brokered deposits appeared efficient during calm periods. But when housing prices reversed and liquidity tightened, those same structures amplified fragility. By July 2008, the weaknesses were no longer manageable through incremental capital adjustments. Part 2 examines how underwriting practices, funding structure, and regulatory supervision combined to turn rising delinquencies into institutional collapse. By early 2008, the pressure inside IndyMac was no longer cyclical, it was structural. The bank's exposure to Alt-A mortgages was central. Alt-A loans were often marketed to borrowers with relatively strong credit scores, but limited documentation. Many loans allowed stated income rather than verified income. Others featured interest-only periods or payment structures that delayed principal repayment. During a rising housing market, these features did not appear immediately dangerous. Borrowers could refinance before rates reset. Property appreciation covered underwriting weaknesses. But when home prices began falling nationwide in 2007, refinancing channels closed, according to regulatory filings and reports issued after the failure. Delinquency rates in IndyMac's mortgage portfolio increased sharply in late 2007 and early 2008. As defaults rose, the bank was forced to increase loan loss provisions. That reduced earnings and strained capital ratios. Capital is the buffer between losses and insolvency. Banks are required to maintain minimum capital ratios under federal regulations. When loan losses rise faster than expected, those buffers shrink. According to subsequent FDIC and Treasury reviews, IndyMac's capital position weakened significantly during the first half of 2008. Funding stress followed. Unlike traditional retail banks with diversified deposit bases, IndyMac relied heavily on brokered deposits and high-yield accounts. Brokered deposits are gathered through third-party networks. They often move quickly when rates change or when perceived risk increases. This funding mix made IndyMac more sensitive to shifts in confidence. In June 2008, the bank announced it would no longer accept new brokered deposits without regulatory approval. That announcement reflected supervisory concerns about capital adequacy. According to public regulatory guidance at the time, banks under stress faced restrictions on brokered deposit growth. The restriction itself signaled weakness to the market. As housing losses deepened and capital tightened, investor and depositor confidence eroded. The widely reported Senate letter questioning IndyMac's financial condition added public scrutiny. Regulators later stated that while publicity may have accelerated withdrawals, underlying financial deterioration was already present. Within days, deposit outflows increased. According to FDIC documentation, more than $1 billion left the bank over a short period in early July 2008. For a bank already facing capital strain, liquidity pressure became decisive. Liquidity risk differs from credit risk. Credit risk relates to whether borrowers repay loans. Liquidity risk relates to whether a bank can meet withdrawal demands in real time. Even institutions with performing assets can fail if funding evaporates quickly. IndyMac faced both rising credit losses and accelerating liquidity strain. Supervisory oversight became a focal point. In later reviews, the Office of Thrift Supervision had primary responsibility for regulating IndyMac in reports released after the crisis. Oversight bodies evaluated whether earlier intervention could have mitigated losses. According to investigative findings, regulators had identified concerns about underwriting practices and capital adequacy before the failure. However, corrective measures did not stabilize the institution before housing losses intensified. The environment in mid-2008 was deteriorating rapidly. Bear Stearns had collapsed in March 2008. Mortgage-backed securities markets were under severe stress. Fannie Mae and Freddie Mac were experiencing rising losses. Market volatility was elevated. In that context, IndyMac's weaknesses became more visible. On July 11, 2008, regulators concluded that the bank was in an unsafe and unsound condition. The Office of Thrift Supervision closed the institution and appointed the FDIC as receiver, unlike later crisis resolutions. That involved immediate whole bank sales. IndyMac initially operated under FDIC control as IndyMac Federal Bank. The resolution process was complex. Eventually, portions of the bank were sold to investors in 2009, and the institution was rebranded as One West Bank. The failure imposed real costs. according to FDIC estimates released after the seizure. The collapse of IndyMac cost the Deposit Insurance Fund approximately $10 billion. At the time, it was one of the most expensive bank failures in U.S. history for uninsured depositors. Losses were immediate and tangible. The FDIC insurance limit before the crisis was $100,000 per depositor. In response to widespread stress later in 2008, Congress temporarily raised the insurance cap to $250,000 under emergency legislation, but for IndyMac customers in July 2008, that higher protection had not yet been enacted. The mechanism of failure was clear. High exposure to declining mortgage categories reduced asset quality. Rising delinquencies eroded capital. Funding reliance on brokered deposits increased liquidity sensitivity. Public scrutiny accelerated withdrawals. Structural risk that accumulated gradually during the housing boom materialized quickly when conditions reversed. Part 3 examines the aftermath, regulatory reforms that followed, and what the IndyMac failure revealed about deposit insurance limits and crisis management. During the early stages of the financial collapse, July 14, 2008, branches that had carried the IndyMac name reopened under federal control as IndyMac Federal Bank. The FDIC assured insured depositors that their funds were safe. For customers with balances below the $100,000 insurance cap in place at the time, access was restored quickly. For those above that limit, the situation was different. According to FDIC releases issued in the days following the seizure, uninsured depositors would receive advanced dividends based on estimated recoveries from asset sales. The ultimate recovery rate depended on the liquidation value of the bank's loan portfolio. For some customers, the realization that federal insurance had limits was immediate and personal. Businesses and individuals who had concentrated balances above the cap faced uncertainty at potential loss. The IndyMac failure was not the largest bank collapse of 2008, but it was one of the earliest major failures in the unfolding crisis. Its timing made it significant. In the weeks after IndyMac's seizure, market conditions deteriorated further. Fannie Mae and Freddie Mac were placed into federal conservatorship in early September. Lehman Brothers filed for bankruptcy on September 15th. Washington Mutual would fail later that month. IndyMac's collapse highlighted structural issues that extended beyond one institution. First, the funding model. Heavy reliance on brokered deposits increased sensitivity to confidence shocks. When regulators restricted the acceptance of new brokered deposits, the signal reinforced perceptions of weakness. Depositors moved quickly. Second, underwriting risk. All day and low documentation, loans were structured around assumptions of stable or rising home prices. When those assumptions failed, loss severity increased. According to regulatory reviews conducted after the crisis, underwriting standards across the industry had weakened in the years preceding 2008. Third, capital adequacy. Capital buffers must absorb unexpected losses. When credit deterioration accelerates, capital ratios can fall rapidly. In IndyMac's case, rising loan losses outpaced its ability to stabilize its capital position. Fourth, REGULATO or Y coordination. The Office of Thrift Supervision was the primary regulator for IndyMac. After the crisis, oversight bodies evaluated supervisory practices. The Dodd-Frank Act, passed in 2010, eliminated the Office of Thrift Supervision and transferred responsibilities to other federal agencies, according to legislative summaries. The goal was to streamline supervision and strengthen oversight of risk concentration. Deposit insurance policy also evolved. In October 2008, amid escalating financial turmoil, Congress temporarily raised the FDIC insurance limit from $100,000 to $250,000 per depositor. That increase was later made permanent. The change reflected lessons from early failures, like IndyMac, where uninsured depositors faced immediate losses. The cost of the deposit insurance fund was substantial. FDIC estimates placed the cost of resolving IndyMac at roughly $10 billion. That figure contributed to broader stress on the insurance fund during the crisis period, prompting increased assessments on banks nationwide. From a systemic perspective, IndyMac demonstrated how quickly housing-related losses could translate into bank failures when funding and capital were thin. The bank's business strategy was not unique. Many institutions expanded into higher-yield mortgage segments during the housing boom. What differentiated outcomes was scale, funding structure, and timing. Behavioral dynamics also mattered. In a rising market, underwriting shortcuts can appear sustainable. Rising home prices provide a buffer, loan performance metrics look stable. Incentives favor continued growth when prices reverse. Weaknesses surface simultaneously across portfolios. IndyMac's failure revealed how interconnected housing markets and bank funding structures had become. It showed that depositor confidence can erode rapidly when public scrutiny increases. It underscored the importance of capital buffers and diversified funding. The broader 2008 financial crisis would reshape regulation, risk management, and capital standards across the banking system. IndyMac was one of the first visible signals that the housing downturn had moved from market correction to systemic stress. For depositors who exceeded insurance limits in July 2008, the event was personal and immediate. For regulators and policymakers, it became a case study in funding risk, underwriting discipline, and crisis response timing. Today, capital requirements are higher. Stress testing is more rigorous. Deposit insurance limits are larger. Supervisory frameworks have evolved, but the underlying lesson remains. When asset growth is concentrated in a single sector, when underwriting assumptions rely heavily on favorable market conditions, and when funding depends on rate-sensitive deposits, vulnerability increases. Understanding that IndyMac failure provides context for how early warning signs in one institution can foreshadow broader systemic disruption. If you value carefully sourced analysis of financial history and regulatory evolution, consider subscribing to the channel for future documentaries.